Good afternoon. It's the international arbitrage here in Miami. We're in Bal Harbor. Um, and today we're talking about international white collar crime. And international white collar crime is very important because unfortunately it's just a reality that we all have to deal with. Now, the global financial system is becoming more transparent. Banks and regulators and authorities are using artificial intelligence and data analytics to analyze transactions. They're crunching more and more data, and and businesses and transactions are being given risk scores. And of course, summarizing everything down to a number is a good systematic approach for banks and other gateways to the financial services system. But a small business in particular is going to be a small international business that is not regulated. The story may be different. And certainly with a lot of banks, especially banks that don't have a lot of international network, international presence, and therefore international understanding, it's very difficult for them to implement the money laundering standard, which is essentially suspicion. And when a regulated business, a broker, a bank, a transfer agent, whatever, that is subject to the anti-money laundering reporting laws, comes across something which they think is suspicious, then they're supposed to file a suspicious activity report. Well, what is suspicious? What is suspicious to people is what they don't understand. But there's a lot of business out there which basically people in banks won't understand. If you're working in a bank in Florida, you may not have ever done business in Nigeria. So someone buying an oil field and doing business with an oil field in Nigeria is going to look suspicious to you. Even when you collect a lot of information on that person and what they're doing, it's going to be suspicious to you. So how do, especially now in today's world where more and more international business is going further afield, it's going into markets which are non-traditional. It's not just Europe and US anymore, it's Latin America, it's Africa, it's Asia. And there's a lot of myriad of ways of doing things, of myriad of types of businesses. And just because you don't understand something doesn't mean it's necessarily suspicious. But nonetheless, this is where we are. And the money laundering legislation is in effect and will continue to be in effect. And so it's a reality that we have to deal with. And so you have to take this into account in your business structuring, in your business planning, in the way that you operate. You have to take this into account to protect your family. If you're doing business in Africa and you hire a compliance firm to do some analysis for you, you might not want to go too far. So you need to speak to your compliance firm about the limits and the extent of their investigations, because at the end of the day, all businesses are not in the business of security assessment and private investigation and all the rest of it. So you have to be really careful with the amount of and the way that you carry out your investigations so that you can verify your source of funds, so that you can get information that you can report to your bank to avoid being classified as high risk and suspicious, and then have your business structure frozen. This is becoming more and more of an issue as banks do more and more analysis of larger amounts of data, and as the banks and the regulatory authorities increase their reach using technology, this is going to become more of an issue, especially for small businesses who are flagged as higher risk by financial institutions, regulated financial institutions, because they often don't understand small owner-managed businesses and the things that they're doing. So white-collar crime and that field of dealing with international money laundering legal issues is something that I have to deal a lot with for a lot of my clients, both proactively on the compliance side. It affects structuring, and then of course when something goes wrong, you have to deal with it. You have to be able to find the right legal team in the right country at the right level. Ideally, you're looking for clients who are family-owned businesses or small, medium-sized enterprises. You're looking for sole practitioners, ideally, who are very good at what they do, who have the right background, and you basically will get to work with them. Say for instance, if you have clients who have trust structures in multiple jurisdictions, the system becomes more transparent. Well, let's say having structures in multiple jurisdictions used to be great, but today, just imagine that you have trusts, say for instance, in 3 different jurisdictions with 3 different private banks in 3 different jurisdictions, and you have reporting a freezing event in one of them. That can quite easily flow over to the other jurisdictions, and now in each legal jurisdiction, you're going to have to hire a different lawyer to deal with the authorities in that country, and it can be very complex very quickly. Say for instance, each country definition of the concept of commingling. The commingling of funds in the US, the definition of it is completely different to that in, say, the United Kingdom. Is completely different to that, say, in Canada. Is completely different to that in Switzerland and Luxembourg. I mean, you get my point. You go on. The definition of commingling is different, and the implications of commingled funds is different. And so, if you have a wide-ranging structure, bank accounts in different jurisdictions, you can find yourself involved in a ruinous amount of litigation. And let's be optimistic here. Let's say that you are really, it's just a misunderstanding. Someone somewhere, some compliance professional somewhere has seen information about you or your company or your transactions and just found it suspicious and has reported it. Well, now you can have, and you remember, your trustees, your fiduciaries are not allowed by law to tell you anything. They can't warn you. They're not going to warn you. And your trustees now can go off and behave very independently. They will get their own legal counsel. They will, remember, they're all in different legal jurisdictions. So the things that they will and won't do are very different. But in general, what I would say is that when these misunderstandings occur, large corporate regulated businesses take very little risk, especially for smaller clients, less than 100 million, of what they will do. You will find that these large brands that you know and trust are not necessarily going to do much to help you resolve the misunderstandings, because they themselves do not really know you and your business that well. And this is why we talk about the importance of really getting to know your trustees wherever and whoever they are. You, the client, the beneficiary, the settlor, you need to make effort to get to know them. You need to put in that work, because it's a risk mitigation issue for you. And so waiting until something happens to then react or think that you can resolve a problem quickly, that's not how it goes. It's not how it goes. I know we are into the area of proactive, many small clients in particular don't like to incur the costs of setting up structures and things proactively. So what I will say is this: if you have multiple structures in multiple jurisdictions, you definitely want to think about rationalizing that as much as possible and using as few jurisdictions as possible. That's one way to reduce complexity, reduce costs, and enable yourself to deal with misunderstandings as the system changes as we move forward. So definitely take that into account. All right, I think that's it for today. Heading back to the office now to see what's going on, but I'll just let you have a look at what's going on out here. Very nice. All right, guys. Cheers.